Welcome to the Finance Village podcast, where we navigate the dynamic relationship between financial professionals, their industry, and the clients they serve in an ever-changing landscape. Let's begin. Hey everyone, welcome back to another episode of Finance Village. My name is Sheldon Seun, your host, and my co-host Sean Adeyemi, and we're going to get right into it. Today's topic is, again, another spicy one after our last episode, referral fees. And I'll tell you why it's going to be spicy. I promise you that some of my opinions on these things, people are going to come at me in the comments. We're going to get into it. So first, Sean, if you could do us a favor, just give us a very quick explanation of the term fiduciary duty. I would submit to you that there's a ton of financial professionals that don't know necessarily that they're thinking about that concept. A lot of people in the bank that have never necessarily even heard that term, that work at the bank, I mean. And for the consumers, how would you explain that to my grandmother or my daughter?
I think fiduciary in the simplest terms just means that you are doing what's in the best interest of your client. Now, there are two terms I think people often confuse, which is suitability and fiduciary, and those are two different things. The suitability standard just basically says whatever advice I'm offering you is suitable for you. It works for you. It's good for you. But I think fiduciary takes that definition a little further that says the advice I'm giving you is in your best interest, has nothing to do with me and what may serve me as an advisor. It's basically what's in your best interest. And when you think about it from a legal perspective of a lawyer. A lawyer is expected to work in the best interest of their client. They're expected to give their client the right information.
But there's a ton of nuance and subjectivity there. So how do we define what level of optimization that each person is giving a client? Because there's so many different ways people want to do their models, and there's a lot of arguing, a lot of I won't even use some of the terminology, but there's all kinds of different attitudes, personalities, and comments in the comment section on LinkedIn about the different business models that people run, because you are able to add revenue to your business by collecting referral fees.
I think, unfortunately, advice in the advice space has been so commoditized in the sense that everybody can call themselves an advisor. Anybody can just say, I'm giving advice without fully understanding the implications of the advice. When we're talking from a fiduciary standpoint, we're looking at, to be able to give fiduciary advice, to be able to give good advice, I think it's important that the advisor has all the information they can on the client. They understand their needs, they understand their wants, they understand their ability to take risk and their willingness to take risk, which are two different things, by the way. And they have the ability to take risk in the sense that they can withstand the advice and the repercussions of the advice that an advisor is giving them, but they also have a willingness to take that risk. But not also that, there's a nuance to it, like you said, in terms of they understand the client and every facet of how the advice you're giving them could affect them. And so when an advisor is operating from a fiduciary standpoint, they're taking into context every information that has been given by that client.
And a lot of information. That's a lot of information, because it's not just numbers, is it?
It's not just numbers. It's the psychology of the client. It's the mental aptitude of the client, right? I as an advisor, I can use a bunch of buzzwords that make it sound like I'm intelligent without the client actually comprehending what I'm saying. And sometimes that can happen where the client is not in their head and say, yes, this is what I want, without fully understanding it. So the advisor also has to know that the information that they're giving the client, that client actually understands it. And that's why it's paramount for an advisor to be able to break down the most complex financial terms in the simplest ways a client can understand it. And then with that understanding that the client understands what you're saying, then give advice based on their circumstance.
That's just to give the advice, and then you have to be able to break down, bringing it back to referral fees, you then have to be able to break down how you get compensated, which is a whole other complexity of like what feels like an industry jargon type of thing.
Right.
So in regards to that trust, Sean, for me, that's everything. That's I don't, you don't necessarily want, when you're self-employed, you have a privilege that you don't have when you're in a cashier in a lineup where you're just given a person that wants to buy a thing and you got to deal with that person. We can choose the clients that we deal with as well in the book of business and the family of relationships that we want to build around us. My opinion on referral fees is, there's a way to do it almost everything in some kind of situation that you construct. We always run into these mental roadblocks, but like we figure out what the compliance issue is. And it's not just about compliance. Again, it should be about full and fair disclosure. I am probably, more of a weirdo open book than most people. So I'm very comfortable with the client really knowing the innards of everything that happens in my business, because I want them to have great confidence in transparency. I want them to really feel that trust.
I think we got to define the referral fee conversation in two segments. And what I mean by that is this. There's the standard referral fee an advisor may get for having a portfolio manager manage their assets. You know what? Let's back up actually, right? The old model has come under a lot of scrutiny in recent years, which is I manage assets, right? Justifiably. I manage your assets. I charge you, let's say I'm an investment advisor, right? I charge you 1% plus whatever other MERs are included in the investment. So let's just call it 2.5. And that model has come under scrutiny, and rightfully so, because there's a lot of advisors who are supposedly providing advice. They have all this huge accounts where they're providing no advice, and they're still getting paid for managing those assets. But in recent years, a lot of advisors, like myself as well, have said, I really don't want to manage assets, not because I don't know how to do it, but because I think it's better to get portfolio managers who are the highest level of fiduciary, which we talked about in the beginning, when it comes to managing client investments. And so I like that model because, one, I get to focus on the planning side of things, which is where my sweet spot is. Now, what I find annoying is when advisors and planners pick one side of the aisle and say, I'm the purist because I don't take referral fees or I don't take any fees from managing your assets, I can give you the best advice. And I don't necessarily agree with that. I believe it's possible to pick whatever fee model, which is one, either manage your assets for you and get a fee for it, or refer those assets or those investments to a PM.
I think you could do a whole mixed bag of all the things. Listen, you can make a great case for the purist and for other ones, but I would submit to you this. It is really, and in most things in life, people are just taking like the surface level attributes. There is a deeper level of attributes and variables in the formula that we can have with an outcome. There is a greater totality to the way that person does business and the way that they do everything. Whether it's they refer you over to someone and they try to make it easier, but first they get your permission to make sure they can send their information over to them instead of just assuming or assuming that you understood it in the teeny tiny fine print that you put in somewhere. Like, okay, I get it. We have to cover a lot of stuff in the fine print, but we can still re-highlight stuff for people disclosure-wise along as we go.
I think we're both making the same point in the sense that I don't think there's a perfect model to service the client. I think it's possible to have a referral fee model where a portfolio manager manages the assets, and you can either decide, okay, for them managing the asset and for me providing the advice, I'm going to get a referral fee. And from that referral fee, I can, let's say, give a client a break. Now, I think where the lines become gray is if I'm getting a 1% referral fee and I'm kind of splitting that referral fee with the client and I'm saying, I'm going to give you out of my pocket 50% of those fees. I think there's a gray line there that may be crossed because of regulations and when it comes to gifts and giving clients gifts. I think there's a way that if you're splitting that fee with the client can border on some gray lines. I would rather give the client a break and say, well, instead of me collecting 1%, maybe I collect 0.8 or 0.7, give you a discount from total.
But isn't that the same thing?
It's the same thing. No, it's the same thing. However, I would rather give you a break than take money out of my pocket and give it to you, just because when an advisor is giving a client money, it can raise red flags. I don't know if you get what I'm saying.
How are they giving it to them? Because I see a lot of the cases, not necessarily all of them, And I do agree. Like I don't necessarily like this, again. Don't get it twisted. What I'm saying, I'm not believing in like a total Wild West of like. I think that there's a really refined thoughtfulness that can be put into a lot of the different kinds of models that people can put in, and we can like. I'm really a believer as I'm a purist as a solutionist. I believe that, well, this is a difficult thing to do compliantly. Forget referral fees. Any compliance related issue. Okay, well, what's the compliance related issue? Let's sit down and critically think about it. How do we make this in a way where it's not doing that, and not in like a sneaky way where we're trying to like slide something through, but in a way that's like really transparent?
I think at the end of the day, as long as the advisor is transparent, that's the one thing I always say is whichever model you pick, whether that's reducing the referral fee so that the client can get a break, or whether that's giving them a gift card, whether that's managing their assets, I think advisors just need to be very clear on how they are paid and what sort of compensations come from referrals that they give out. I don't believe that there is a one size fits all. I think it's possible to be fee only and not get any referral fees. I think that's great. And I think it's possible to give advice and still get a referral fee and still really be giving the best advice. I don't think there is a best model.
Yeah, it's really going to come down to just a level of what the totality of the quality of transparency and disclosure and the quality of vetting that the person is even able to do of these other professionals, or if they're just picking a rando and they can't competently pick someone that they should be referring you to. There's a lot in it. So tell me, best practices for referral fees. Obviously transparency is kind of one of those main things. We can just put it in the fine print. To what extent? What are the methods that we're gonna recommend that people are doing the full and fair disclosure? So because you're not going to go through all the fine print in the first meeting.
No, but typically, if you're providing advice, you're kind of giving the client a ballpark. Here's what we're going to charge you upfront if you do upfront fees, and if you don't do upfront fees, well, here's approximately a percentage of what we collect from our PMs or from our referrals if you work with us or if we refer you to that. So I think at the very least, there needs to be a document that says we get paid referral fees. You don't necessarily have to state the amount.
Here's what I'm going to say about this. Be clear. Be confident. Stand with your chest out and be confident.
Absolutely.
But go out and put the intention in the relationship to choose somebody so awesome and hold that person accountable.
I think one piece that we haven't talked about, but we really should, is yes, collect the fees, but make sure you're delivering value. Make sure you're doing what you say you are going to do for collecting those fees. Don't just have accounts that you're collecting fees on an annual basis and you're not providing any value for the client, because it doesn't matter how much disclosure you're giving, how much fine print you're giving. If you're not giving real competent advice, then you shouldn't collect those fees. End of story.
Well, I love that I love that point that you're bringing up as in relation to referral fees, because if somebody's bringing you unbelievable value and they're making sure even to check in with, those professionals to make sure they're taking good care of you when you send them over to them and all the different things, like if somebody's offering you tremendous value, being creative about how they offer that value and being, even sometimes when we're failing, if we show that the intention, like I've made all the mistakes that you can make in mortgages, and I've seen them all happen around me with the appraisers and the underwriters and the funders and the lawyers and all the different millions of people you got to deal with. When they trust that your heart is in the right place and that you're immediately and quickly on it and updating them, you get so much grace.
Absolutely.
So much grace. So if somebody's offering you tons and tons and tons of value, are you really going to be that worried about, and again, disclosing it? But is that really going to rub you weird? For me, it doesn't.
No.
It doesn't. If I have that type of person that has the totality that I'm looking for, I'll scrutinize them heavily to make sure I have it. I just have a lot of trust for them.
I think you bring up a point, because sometimes advisors do a lot and they don't actually show what they're doing. And I think that's something that advisors need to do a better job of, in the sense that we may only talk once or twice a year as an advisor to a client, but here are all the things I'm doing for you throughout the year. Here are the checkpoints. Here are the ways I'm taking care of you. And I think good advisors do some of these things just intuitively. We don't even think about it. And sometimes that's where the disconnect may come, where the client may look and say, what has this advisor done for me lately? But there are all these things they're doing. So I think part of also being a good advisor is to highlight and demonstrate, here's what we're doing throughout the year for you.
So in regards to referral fees, we should do that more about our partners, right?
What do you mean?
Again, we're talking about referral fees. So in relation to what you're saying, we need to do a good job saying, here's the awesome people I deal with. Here's the clear type of relationship we have. They're really great, but if there's any issue, let me know. I'll give them a kick in the butt. Mm-hmm. We need to be able to, I think, maybe sometimes better represent our ecosystems and our network in a way that's not that conventional, just this is a referral partner thing, but really find ways to, I would even say, join together with those people and market ourselves together.
Can I say, and even fire some of them if you have to?
Yes,
right?
Yes, you got to be able to fire. You got to be able to break up with them as quick as you're going to break up with anything else.
Because I've had PMs I worked with in the past, but I think after about 2 years, and part of the feedback I also get is from my clients, is like, what's your experience with this PM like? What is their responsiveness when you have questions? And what's the performance is just one metric, but there's so many other metrics we use to analyze some of the referral partners we have. And I think advisors also need to be clear to say, well, if this PM is not delivering on the promise of either rebalancing the portfolio, adequate communications with the client and those things, I think advisors as well need to be able to go to the client and say, well, I know I recommended this PM 3, 4, 5 years ago, but I've just been looking at the performance and the level of service, and I don't think it's really up to par with what we really aim for you as a client. So I may have made a mistake referring them in the first place, but here's just other partners that I've been vetting behind the scenes for the last few years that I think could be a great partner.
Beautifully said, Sean. Beautifully
right?
said. Beautifully said. I love that. It's so important. It's so important. It's the same as if you're just going to stick in a dating relationship because, like, you both have the same interest. You like driving four-wheelers together. Like, you have to be very intentional about the relationships that you have. And I would even say, Sean, we should insert a link. We're going to create a checklist that you should go through, and not one that we delegate to people, but the questions they should ask themselves. Like, what do you have any standards that you want to have as a response time within your ecosystem or your network of people? Maybe not everybody's going to be the same. Some people be 1, 2, or 3, but okay, 3's the max. If you're not getting back to my client within 3 days, I'm now wondering what type of business you're running.
Mm-hmm. Do what you say you're going to do as an advisor, as a referral partner, and I think everybody needs to be held accountable, right? For the referral model, I do believe that it offers the best of the both worlds for clients because it allows me as an advisor focus on the plan and relationship without having to double up as a portfolio manager. It also drives down costs for the client because a typical mutual fund where clients are paying 2.2, 2.5%, and it's a closet index fund, I think having a PM manage it on a passive basis and charging a lot less than a mutual fund would, it works for the client. The average fees on a PM referral is maybe 1.6, 1.5, give or take. Whereas a client invested in a mutual fund, even on the fixed income mutual fund, they're paying 2.2, they're paying 2.5. That's a 0.4 to 5% basis points difference. Over 5-10 years, that's a lot of savings for the client. So I'm an advocate for the referral model because I think it drives costs down and it keeps everybody accountable. It keeps the PM accountable, it keeps the advisor accountable, and it keeps the client happy.
And remember, the referral model comes with no fees too. You could just be referring heavily. Sometimes it's not easy though, because some relationships are like they come across a lot more opportunities on one side, and you're only ever sending in one direction. And then what level, let's quickly talk about before we wrap up here, what level of intentionality do people actually have when there's no incentive whatsoever? You can all go walk around and parade like we're this awesome person that's going to really put the free effort and time into like doing all these additional things, or really making sure after somebody's had 3 bad accountant experiences and 2 bad bookkeeper experience and everything's a mess and they really need some time and attention, not just a referral, whatever, but like, okay, tell me what kind of situation you have. Is it all in, boxes? Do you owe money to CRA, whatever else? And then bridge that, coordinate that a little bit more intelligently instead of, oh, you have an accounting mess? Okay, yeah, go talk to them. Or good luck, I'm not going to tell you anybody. put some intention to it to get that holistic collaboration that we need in that new era of finance to really bridge that conversation over and figure out what you can do to be additionally useful. I want my person getting a perk there. So we're going to have a few resources that we're going to leave out of this. They're going to help people kind of really think about the relationships that they have, think about any gaps they may have in their ecosystem where there's a great solution they could be offering clients. And even if you don't want to pay someone referral fees to do the business, then just take more business for yourself, because if you're in a conversation with a trusted ecosystem where you have robustness, you've got your home and auto person even, you've got all the different kinds of people that you trust in your ecosystem. And no, you don't have to take great time out of your day from doing your business to go and find these relationships if you're busy and you're doing business. But if you have time for doing more business, be somewhat intentional about what you're creating in your ecosystem, in your network, in your opportunity. And with that, we'll have a quick word about pocket finance. 92% of people trust referrals from people they know. There's a better way to make those introductions. Wrap your arms around your client with your professional team. Join your client's team free today. PocketFinance.com.